Ben Powell joins us now. Let's take a conversation forward. He, of course, is Chief Middle East and APAC Investment Strategist with BlackRock Investment Institute. Nice to have you back. When we interacted with you at the beginning of the year, it was US market all the way. We did not interact with you in the month of April, but it was emerging markets all the way. Just when the world got convinced that emerging markets could come back, US markets have also made a comeback. It reminds me, Ben, of this seesaw game I used to play as a child. One side is up, the other side is up. And before you realize, the side changes. What is happening to the world, my friend?
Good morning. Great to be with you. Yes, the roller coaster continues. And I think that's something we're all going to have to get used to. So a quick point, just in passing, I think, again, the last month has been a reminder to us as investors where we can to kind of stay calm, try to look through some of the very short-term noise and focus on longer-term structural changes and allocate our investments accordingly. I think that's what the market has kind of pivoted back to over the last few weeks. And we've been reminded that, sure, there's many things to be concerned about, not least the trade tensions, but there are many, many tailwinds globally, including the AI megaforce, and of course in India as well, with what seems to me to be quite an encouraging combination of lower oil price, potentially some good news coming with the US vis-a-vis a trade deal. So for now, it feels like it continues to be a much more positive environment than perhaps when we last spoke.
Ben, so what has changed? The trade deals are still not in place. The US economy is likely to slow down, and the evidence that there would be a supply disruption would be felt in the coming quarter. So markets know that next 2 quarters would be hard to call. Then what explains this comeback in equity markets, especially what we saw last week?
I think it's earnings. So again, many things to worry about, but as we look at actual numbers like facts, for now, the data continues to be quite strong, actually, in the US and globally. So in the US, we're mostly through the most recent earnings season, and they've surprised to the upside much across the board. But in particular, the big stocks, like it or not, we have a huge concentration in the US around these tech behemoths. So global equities are, again, it's kind of uncomfortable, but we are sort of dependent on how well these companies are going. And the good news is, for now, they continue to go very, very well, driven by the AI super boom, which continues unabated. So the earnings have been strong. That's, I think, the reason why we've seen the S&P up 9 days in a row. By the way, that's the first time that's happened since 2004. So kind of a historic rally for the moment unfolding, which is dramatic and exciting. But the reason, I think, is very normal and much more prosaic, which is to say earnings strength and resilience for now, driving that upward move we continue to see.
Okay. Ben, at the beginning of the year, as an institute, you were a big votary of US equities. Then we saw what could be called as this mid-air turbulence. As we roll forward, let's say by the end of 2025 or a year from now, which end of the equity market or which end of the world do you think will outperform, underperform, and will be in line with market performance?
So the first thing I would say is we think this is really a different global equity market from 5-10 years ago. At that stage, you could kind of be risk on or risk off. We now think you need to be much more picky, much more selective, even within the umbrella term called emerging markets. They're not all the same, obviously, but we think that's really true in a fracturing world. I mean, sadly, the world is fracturing geopolitically, trading-wise, economically, and so forth. And what that's going to mean is more dispersion. So we really need to be thoughtful around what we pick. To give you a couple of answers, we continue to like the US. It's still the epicenter of creating the future. They've still got the universities and the ability to monetize the intellectual property they create. So the US for now really central to the AI super boom, which we think continues, and the data, as I just mentioned, is supportive of that. That's one. Secondly, I'll talk to one emerging market we continue to like, which is India. So India, in a way, it's quite interesting, right? India was kind of ahead of the game in being worried. So had its sell-off a few months ago. Now I think we've got a much more interesting position in India with tailwinds, actually, potentially from the geopolitical fracturing, where India is in, I think, a really strong position to carefully and respectfully negotiate great deals with different counterparties, not just the US, but more generally. That's one. Two, OPEC announcement over the weekend. Oil prices falling looks likely to continue. Obviously, that will benefit India in aggregate, different parts of the economy differently, but in the round, that's a good news. And that should give the RBI, if they feel they need it, more room for maneuver. So I look at India as an example of an emerging market which is actually benefiting from a number of these mega forces. Even in a more complicated world, there are still tailwinds out there. And it seems to us at the BlackRock Investment Institute that India is the right side of a few of them.
Right. Very good morning to you, Ben. This is Cheryl also joining in the conversation. And you did say the fact that the earnings growth or the earnings visibility is one of the reasons why you have the equity markets actually rallying back in the United States, and also will actually command more premium when you talk about the rest of the globe. But we have to also keep in mind exactly what lies ahead in the future. We've not yet actually taken into account what could lie ahead when you talk about Trump's tariff, because there's just a 90-day pause, which we are through almost to about 20 days or so. That sort of will have an impact on the earnings growth going ahead, the way how you will have the labor being employed, the way how the companies will actually do business going ahead. Don't you see that as a risk factor going ahead?
We do. And to be clear, we actually expect a contraction in the US economy driven by some of the reasons you've talked about. So there's, again, there are things to be worried about. The future, always a hard place to kind of travel, but it feels particularly uncertain at the moment across many different dimensions. That's true and important. But look, we've just got to relax and accept that, right? We can't be as confident looking forward today as we probably were 10 years ago, where with hindsight, I guess, it turned out we were in a time frame called the Great Moderation, where inflation was low, interest rates were low, and that was then. Now, everything seems much more complicated, whether that's AI, geopolitics, trade tensions, and so on and so on. It's a long list. So we just need to kind of accept that. It's uncomfortable, we just accept it and get back to the basics of investing. And for us, even though we recognize some of these significant headwinds, they're real and important. So now we think they are being outweighed by the tailwinds, which include artificial intelligence, an absolutely amazing technology, I think, not to get too grandiose, but a historic moment in human history. And now back to our kind of more level, our normal level, which has important implications for markets, which are still not fully priced in our opinion. So to be clear, we think you're going to get I totally understand. This sounds a bit strange, but we think you're going to get a US contraction driven by some supply constraints. And yet, yes, indeed, we are still overweight US equities, largely because of the AI megaforce, which is extremely powerful and driving those big companies forward.
Ben, we've debated this on various forums, and I'll encourage your thoughts on this. AI is ultimately an application, which is that it will boost productivity and it will kick in efficiency. But if the core demand is contracting, which is what is happening in the world and which is where US economy is moving, the core demand will contract because spending goes down. Spending goes down, multiplier works against you. Then what will happen to AI implementation? If demand is not there, who will implement?
I think everyone. So I think the need for productivity gains, efficiency gains is actually only more the case if you're feeling a bit uncertain about things beyond your control. So many big companies, of course, they're watching the news like everyone else, right? It's not clear exactly how these macro kind of issues are going to play out as the elephants discuss them at the government level. So if people running companies, even big companies, they can only control what they can control. And I think actually the global uncertainty in the backdrop is likely to create an acceleration around trying to become a more efficient, more productive company. Again, that'll be different for different parts of the economy. But for now, when we look at the spending which is going into AI, it does seem to be absolutely powering forward, not only just keeping on, but absolutely powering forward. And there are a few reasons for that, but I think one of them is companies even more focused on what they can control, and if they can, make their workflow process 10% more efficient, that's a huge deal, and that's something they can control. Whereas obviously President Trump's negotiations is not something they're so directly involved in. So I actually think the trade tensions and some of these other big issues at the government level probably give companies even more incentive to get on and try and become more efficient, better companies, which should be in time good news for shareholders as well.
Okay. Ben, where does emerging market fit in? The kind of flows what we've seen into India, I think they are quite impressive. Do you think this is the beginning of a trend change for emerging markets, and especially markets like India? You rightly mentioned that India has got everything going for itself. So could India be a disproportionate beneficiary of this entire changing order?
I think so, yes. I mean, again, like nothing is perfect in life. We always have things to worry about. But when I look at India and some of the mega forces, its position vis-a-vis the geopolitical kind of difficulties, India should at least be a relative winner. It might even be an absolute winner, where it can, again, carefully and skillfully think about how to benefit from its position, its huge size as a market. It's clearly a very attractive proposition for everyone. And it seems to me it's incumbent on India's leadership to do the best for India's people. And that's what I would expect to play out in the weeks and months ahead. Furthermore, the relocation of supply chains, easier said than done. You can't just click your fingers and move massive global supply chains. But it feels again that even that's a global disruption, India should be the right side of it. And then the very well understood domestic story. I mean, I don't need to tell you guys or anyone on the line here, but it's still true, right? So the demographic story, the amazing advances around digitalization, the astonishing kind of onboarding of maybe tens or even of hundreds of millions of Indians into the formal financial system, including equity markets and other markets, that's still true and ongoing. So yes, I think there's a lot of kind of things to pass. All emerging markets are not the same. We need to be careful about talking about painting with too broad a brush. But when I look more into the details of emerging markets, I think India actually stands out a bit as an economy and a market where there are multiple tailwinds, which I think can continue to attract more global investment over time, both structurally and more short-term flows into markets, which, as you rightly say, we're starting to see signs of in the last couple of weeks.
Ben, I wanted to understand and get your view. Do you think that the bond yields could be a factor that could actually spoil the party going ahead?
A bit, yes. So thinking more about the US as kind of the big economy and the most important price in the world, maybe is the US 10-year yield. We think that's going to go up over time. And the reason for that, a couple of things. Firstly, sadly, inflation in the US is still a fairly big problem, right? So inflation is already too high, and that's before the inflationary impacts of the trade tensions have fed through. So inflation is already too high, likely to go higher. Clearly, that slightly restrains the Fed from their ability to kind of do any cutting anytime soon. So firstly, inflation is kind of more complicated, meaning higher. Secondly, when you're investing in the longer term, you're taking more risk. You don't know what's going to happen over the next 10 years exactly when you're investing into a 10-year bond. And you should be compensated for that risk. That's called term premium. We think, given the uncertainty in global markets, global everything, frankly, the uncertainty's gone up, and therefore the risk, the reward you should demand as an investor has gone up commensurately. So a combination of higher inflation and higher term premium, we think should mean the 10-year yield drifts up over time. That's like a very big deal, because traditionally the US 10-year, US fixed income has been a very obvious safe haven. Again, that's much more nuanced now. And as investors, we need to be careful about picking our spots as to where we can find market ports of storm in choppier days ahead.
So Ben, what should one do? US markets, or in general equity markets, are at reasonable levels. Gold is at a record high. Bitcoin is doing rather well for itself. There is no big sell-off in the bond market. I mean, is it one of those worlds where you have problems of plenty? Because too much to choose from. I mean, there is a time when equity does well, there's a time bonds do well, there's a time commodity does well. Right now, everything is doing well.
I think the linkage, I think, through your point there is still, for me at least, is inflation. So I still think we've got a high inflation, particularly in the US. As I mentioned, kind of by construction in a way, tariffs are an increase in price, right? An increase in cost, which feeds through to price. So I would expect to see more inflation driven by trade tensions and tariffs. So I think when we're thinking about investing, firstly, try and stay calm. I know that's easier said than done, but stay focused on your investment goals. Try and stay diversified and invested, because market timing is difficult, right? So we at BlackRock would be much more focused on, as they say, time in the market rather than timing the market. But then this inflation point, I really think is still important. So having a kind of real focus on inflation resilience, and you can take that thought, as you did in your question, in different directions: equities, real estate, maybe gold, even some of those assets. Like worrying about inflation, I think makes sense, because inflation is already too high in the US and likely to continue even higher, actually, as the tariff kind of difficulties kick through. So stay calm, stay invested, stay diversified, worry about inflation and express that in different ways through your portfolio has kind of worked over the last weeks, months, and even years, actually. And I think we think at the BlackRock Investment Institute is kind of the right approach looking forward as well.
I'm also wondering, how this entire tariff tirade, if you will, is actually going to pan out. I mean, we were just looking at the takeaways from the Berkshire Hathaway AGM, and even, Buffett was extremely critical, saying that, US should not be using tariffs as a weapon against the rest of the world. I was reading over the weekend, I don't know how much truth there is to that Trump is even willing to reduce tariffs on China. Do you think it's going to end it at a stalemate, or will there be something conclusive eventually?
I think, honestly, I think it's hard to say. So I think we as market participants just need to become comfortable with the uncomfortable phrase, we're not quite sure, right? So it's very hard to try and disaggregate how much of the US administration's approach to tariffs is negotiating. Are these just kind of very aggressive opening bids in an ongoing conversation? Probably a bit of that. Are they genuine attempts to kind of fundamentally change the US tax system, moving the burden of taxation onto foreigners and away from hardworking Americans? Probably a bit of that, and so forth. So I think it's very hard to be overly certain about exactly what's going to play out. We just need to, again, relax and learn to love the uncertainty. And I think what we can do is really focus on the things we can control. That's like earnings, focusing on actual companies, sectors, even particular geographies and asset classes. And as best we can, trying not to get too caught up in the mega macro news flow. Don't misunderstand me. Obviously, that's important. What I'm saying is there are other things driving share prices. And the last couple of weeks, again, I think this is a stat worth dwelling on. The S&P's gone up 9 days in a row. First time it's done that since 2004. Who would have thought that 2 weeks ago? But that's where we are. And there are reasons for that, these tailwinds. So continue to be appropriately humble about the big picture. We don't know what's going to happen on social media today, tomorrow, and the next day. What we do know, for example, is that AI megaforce. Sorry, I know I keep mentioning, but it's kind of a huge deal. As an example, that continues to be a very powerful tailwind. And for now, at least in the last couple of weeks, that's been enough to drive a pretty powerful upswing. And potentially there's more of that to come.
So, Ben, just to wrap it up with a last but one question. What exactly are markets pricing in on the inflation front? A minor uptick, or 1%, 1+% is something which markets can digest?
I think so. So I don't want to get too kind of complicated here, but what's interesting, I think what markets in general are struggling with are two very different futures, right? So there's a future, actually to the previous question, where it's kind of all a trading game, a negotiation, and most of the tariffs will come off. That's like scenario A. Or President Trump and the US administration, they kind of really mean it, and that's scenario B. So those present two very different futures for everything, including inflation. And so what the market has to do is to kind of take a blended average of those two different futures. So the reason I'm giving you this overly long answer is I think we need to be careful. The market can only kind of discount a blended mean, as I say, like one number. You look at sort of forecasts, how many times is the Fed going to cut or whatever. that's fine, but it's actually more complicated than that. We're two very distinct scenarios. So we at BlackRock, we're really focusing on the different scenarios looking forward and trying to think about how the market is jumping around between those different scenarios as we get different data day by day. To take your question more directly, I think the US is still kind of forecasting inflation in the high 2s, let's say something like that. That to us looks still a relatively low number when we think about the structural changes around us, tariffs, maybe tighter labor markets if the administration becomes more assertive on immigration policy and so forth. So that's the specific answer, but it's actually part of a broader conversation around the markets having a really difficult time trying to present value these very disparate kind of futures, which we need to weigh dynamically over time.
Okay, Ben, so good to have you on the show. Thanks for your time as always.
If you like this video, then like, share and subscribe to ET Now.